AI bulls saw a pullback when the world was fully introduced to artificial intelligence upstart DeepSeek, and our next guest believes it may have started a rotation within the sector. For more, let's welcome in Ellen Hazen, F.L.Putnam Investment Management Chief Market Strategist and Portfolio Manager. So Ellen, let's start there. You believe we're in this rotation away from hardware vendors towards software vendors. What are the implications of that at this stage of the AI trade?
That's a great question, and that's exactly what we're seeing. We've all seen the DeepSeek news that came out a few weeks ago at this point, where it looks as though the cost of using AI is much lower than what we thought just a month or two ago. What does that mean? Well, it means that the companies that are deploying AI are going to be able to build models much more cheaply. They're going to be able to roll this out to their customer base much more cheaply. The whole question about, oh, well, are you ever going to get an ROI on this model? Well, that's an easier question to answer if if the cost of building the model is much lower. So just as we saw with the internet rollout back in the late 90s, early 2000s, initially the play was hardware. Remember JDS Uniphase, Cisco, and so forth. But then what happened afterward? It was the companies that were using that as a platform, the companies that built on top of that and offered products directly to other businesses and consumers that ended up being the real winners there. Companies like Facebook, companies like Amazon. And you're going to see the same thing here. So you're going to see the software companies and the hyperscalers accrue more of the AI value than we thought a month or two ago before we realized that the cost of AI was coming down so quickly.
You know, it's interesting because the defenders of some of those hardware companies will say, well, if it's cheaper, that means they could do more volume, right? They can just sell more of the stuff if it's at a lower cost. I'm curious what you think about that take.
I think we all learned in Economics 101 that the demand curve is downward sloping, and the more expensive something is, the lower demand is, and so forth. Or I guess this the other way around. And so therefore, it is true that if something is cheaper, you are going to use more of it, right? No question. The question is, if it is 20% cheaper, are you going to use 20% more, right? If it's half as cheap or half the cost, are you going to use twice as much? And we don't know what that elasticity of demand is going to be. I do think when you have a dramatic price decline, what you're likely to see is definitely an increase in uptake, but more volatility. And so it's not going to be clear for a while whether or not the increased uptake is large enough to offset the fact that it's going to be cheaper per. I don't think it's necessarily a straight line, but I do think that we have proven, think about it, right? With things like memory, the amount of memory on your phone, the CPU power on your phone, the amount of storage for your camera, and so forth. Every time we get cheaper storage or cheaper CPU cycles or cheaper capability, we find a way to use it. So I don't think that's a question. I think it's just a question of timing. How quickly will that happen? And will there be an air pocket in the middle somewhere?
Ellen, is this a rotation that would have happened regardless and DeepSeek just accelerated that timeline? Or did DeepSeek represent this fundamental moment where the narrative just completely changed?
I think that the cost was always going to go down, just as electronics costs have gone down for generations. So that was always going to happen. I think the narrative that changed was really more in the stock market than in the underlying technology. So I think that there were investors who believed that NVIDIA and other stocks like that were going to be able to maintain pricing power and have very high volume growth indefinitely. And that narrative has shifted. But I think for practitioners, for people in the industry, they knew it was going to come down. Did it come down more suddenly? Perhaps, but I don't think it's a fundamental change in the narrative.
So, Ellen, all of this said, are you guys redeploying in this direction that you're talking about, sort of away from hardware and more into software, or are there other areas of the market that you think are even more attractive right now?
We're doing both. We are definitely taking some of the gains off the table in the hardware space and redeploying that into some software names like Salesforce, like ServiceNow, and others. But at the same time, we're also looking beyond the Magnificent Seven to more of the other 493 names. So we're looking at some healthcare companies like Stryker, Artificial Knees and Hips. We're looking at some industrial companies like AECOM, which does power infrastructure, and we're looking at other companies across other areas in financials and across the board outside of just technology.
Are there any trades maybe in the software sector that you should avoid at this point, or maybe take a more wait and see approach, since we've seen how quickly stocks and the market reacts to a lot of these headlines?
I think on the software front, you always need to be careful about not overpaying for growth. Most software stocks that are worth owning are going to be expensive, and so you do need to pay up a little bit for them. But because the multiples are so high, that means that if you see a hiccup in fundamentals, then the stock is more likely to have a dramatic downturn. And so you want to look at a couple things. Number one, you want to look at the free cash flow conversion and make sure that they're turning their earnings into free cash flow. And number two, you want to look at the earnings multiple compared to its own history. And if it's expensive, but it has always traded at that kind of multiple, that's one thing. But for a stock that used to trade at 30 times and now it's at 60 times, I think that's where you might run into trouble. Finally, the last thing we really focus on are earnings revisions. As long as earnings revisions are going up, you might be able to hold a rich multiple, but if earnings revisions start to be negative, then you're going to be in trouble when you have that high starting valuation in the software space.
Ellen, good to see you. Thanks for joining us.
Thanks.